Hey everyone, welcome back to FX Limit. If you're into Forex trading or just starting out, you know how crucial it is to make informed decisions. And one of the best ways to do that is through fundamental analysis. Today, I'm going to walk you through a step-by-step guide on how to conduct a fundamental analysis for a currency pair. So let's dive in. First things first, what is fundamental analysis? In simple terms, it's a way of evaluating a currency by looking at the economic, social, and political forces that may affect its value. It's like being a detective, gathering all the clues to solve the mystery of where the currency is headed next. Step 1. Understand the basics of the economy. Start by understanding the basics of the economy of the country whose currency you are analyzing. Look at indicators like GDP growth, unemployment rates, and inflation. These give you a broad picture of the economic health of the country. A strong economy usually strengthens a nation's currency, while a weak economy can lead to depreciation. Step 2. Keep an eye on interest rates. Interest rates are like the magnets of the Forex market. They can attract or repel investors. Higher interest rates offer lenders a better return relative to other countries, attracting foreign capital and causing the exchange rate to rise. On the other hand, lower interest rates can lead to a decrease in the currency's value. Step 3. Monitor political stability and economic performance. The political climate of a country can have a huge impact on its currency's value. Countries with less risk for political turmoil are more attractive to foreign investors. For instance, if a country is going through political unrest, foreign investors might pull their money out, leading to a depreciation of the currency. On the other hand, a stable country with strong economic performance can attract foreign investments, boosting its currency. Step 4. Consider the country's trade and capital flows. If a country is exporting more than it's importing, there is a demand for its currency, which can increase its value. Similarly, if there's foreign investment in a country, it will likely require the country's currency, increasing the currency's value. Keep an eye on trade balances and capital flows to understand these dynamics. Step 5. Evaluate economic indicators. There are numerous economic indicators released regularly, like Consumer Price Index, CPI, Producer Price Index, PPI, Purchasing Managers Index, PMI, and employment figures. These indicators provide insights into the economic health of a country and can influence the currency's value. Make sure to keep a Forex calendar handy to track when these indicators are released. Step 6. Factor in world events. World events like natural disasters, terrorist attacks, and major political events can create uncertainty and may impact a currency's value. Stay updated with global news to factor in these events into your analysis. Step 7. Compare and contrast. Once you've gathered all this information, it's time to compare and contrast. Look at the fundamental factors of both currencies in the pair and determine which one is stronger. Remember, Forex trading is always about pairs, so you need to consider both sides of the equation. Step 8. Make a decision and stay updated. Based on your analysis, make your trading decision. But remember, the Forex market is highly volatile and things can change quickly. Keep yourself updated with news and be ready to adjust your position if necessary. And that's it, folks. Fundamental analysis might seem daunting at first, but with practice, it becomes a powerful tool in your trading arsenal. Remember, no method can guarantee success, but being well-informed can significantly increase your chances. Thanks for watching, and make sure to like, share, and subscribe to FX Limit for more Forex insights. Until next time, happy trading.